Welcome to CBDC's learning video session on building a budget. By building a budget, you detail what you expect to pay in expenses and also what you anticipate to earn in revenue. By recording the expenses and the revenues on a spreadsheet, you will be able to determine the annual potential profit or loss of the business. The profit or loss of the business is calculated by subtracting the expenses from the revenue you generated. Your revenues include all the money coming into the business. Revenues can come from a product sold or a service performed direct to the client. You can also generate revenue through indirect selling, such as renting part of your office space to another business owner or renting the use of your workshop equipment. Revenue can also be money the business received from a government subsidy or grant. Expenses are determined based on variable and fixed costs. Variable costs are the expenses that fluctuate in price, which often includes all the materials used to provide your product or service. These are often called direct expenses or cost of goods sold. Fixed costs are the expenses that are the costs that stay constant. Fixed costs are everything you need before producing the product or providing the service. Often these are referred to as overhead costs. The variable costs or cost of goods sold are the expenses that often change depending on how much you sell. Let's look at cost of goods sold. Cost of goods sold, known as COGS, refers to the direct costs incurred by a business to produce or purchase the goods that it sells during a specific period. It includes expenses directly associated with the production or procurement of goods or services that are sold to generate revenue. COGS is an important figure in calculating profitability, as it helps determine the gross profit of a company. First, let us look at direct materials. These are the raw materials or components used to create the product. For example, in manufacturing, it could be materials such as steel, plastic, and fabric used to make a finished good. Or the components could be the screws or the hard drive to build computers. Business owners also need to consider direct labor costs. These are the wages and benefits paid to workers who are directly involved in the production process. For instance, these are the factory workers and assembly line operators, or any other personnel involved in creating the product. Another area that needs to be included in the cost of goods sold are the manufacturing overhead costs. These are the direct production costs that are not classified as direct materials or direct labor. Direct production costs can include the factory utilities such as electricity to run machines, the depreciation on factory equipment, and the maintenance of production equipment. And lastly, freight costs need to be included in the cost of goods sold. These are any transporting costs to get the raw materials or components to the production facility and to get the product to the customers. Now let us look at fixed costs. Fixed costs or fixed expenses are the expenses you need to pay whether you sell a product or your service. Fixed costs may even be the costs that you need to spend before you even start producing the product or providing the service. Fixed expenses are often called overhead expenses, which can be the rent, electricity, technical support, or ongoing required services, such as insurance and sometimes labor. These costs do not change whether you sell 1,000 units or 100 units of an item. Labor costs can be variable or fixed costs. Business owners need to separate the variable labor cost from the fixed labor cost. Fixed labor cost and variable labor cost are two types of labor-related expenses. Fixed labor costs are the expenses that do not change with the level of production or sales. They remain constant regardless of how much or how little a company produces. The characteristics of labor costs are that they are consistent and predictable, as they do not fluctuate based on the amount of work done. Examples of this are the salaries of permanent employees such as office staff, managers, and supervisors. Fixed labor cost also includes the employee benefits you may pay for health insurance or retirement plans that are fixed regardless of output of your production, or sales volumes. It can also be contracts with employees that require a set payment for a certain period of time, regardless of the work or volume that is being generated by them. The impact of fixed labor costs are that they contribute to a company's overhead costs as they need to be paid even during periods of low production or sales. In respect to variable labor costs, these change directly with the level of production or business activity. The more a company produces, the higher the variable labor cost. Respectively, if the company production goes down, so does the labor cost. The characteristics of labor costs are that they are flexible and they fluctuate in response to changes in output or sales. Examples of variable labor costs are the wages for hourly workers, whose pay depends on the number of hours worked. They represent the overtime pay, when additional work beyond normal hours results in higher pay. It also accounts for the temporary or contract workers who are hired based on production needs. Variable labor costs shift as they move in line with the changes in production and sales. A very important budget item that needs to be considered is the cost associated to what an employer needs to pay over and above wages that are referred to as labor burden costs. Labor burden costs include expenses an employer pays in relation to payroll taxes which are required by law, such as Canada pension and employment insurance premiums and vacation pay. And, depending on the industry and number of employees, potentially the owner may have to pay workers' compensation. Labor burden costs can also include employees' cell phones, vehicle allowances, training fees, and health benefits. Labor burden costs are an area of budgeting that can be complicated. Therefore, it is recommended to talk to an agent at Canada Revenue or hire an accounting expert to assist in determining what labor burden costs you may be responsible for. Let us talk about you and what you get paid. As a business owner, you do not work for free. So as a business owner, you need to take a salary, as though you were an employee. Or, by taking a cash draw, that comes out of the company's cash flow. Whether you decide to take a salary or draw, use a realistic figure that reflects your responsibilities as a business owner and what your personal needs are to support your personal expenses, such as mortgage payment and household groceries. Trying to decide the amount you can take from your business can be difficult as you do not want to put financial stresses on the business or yourself. Often, business owners rely on an accountant to help them determine the amount and method to which they should be paid for the work they put into the company. Now that we have a better understanding of variable and fixed costs, we will look at these costs in relation to different types of businesses. First, let us look at a food truck business example. If you were operating a food truck business, the revenue sources are the sales generated by selling hamburgers, fries, and beverages. The variable expenses in relation to these items being sold are the meat, vegetables, condiments, beverages, packaging for the burgers, and the propane to cook the food. The fixed costs associated to operating the food truck business are the items that must be paid regardless of whether you sell 50 hamburgers or 100 hamburgers. The fixed costs to operate a food truck may include things like the fuel for the truck to get to the place where you are going to be selling the products you make, the permits required to park or operate the food truck, and the ongoing business's bookkeeping expenses. Let us look at what the variable and fixed cost may be for a service repair-related business, such as a plumbing business. Revenue sources for a plumbing business could be the hourly rate they charge to the customer for the services of their plumber, the materials used, and travel to and from the job site. Variable costs may include the materials used such as PVC, which is a commonly used material for drain, waste, and vent systems used to repair water supply lines in residential settings. Typically, an owner of a trades-based business, such as plumbing, often sell the materials used at a markup price. Markups can be necessary to help pay for the fixed expenses. In a plumbing business, the fixed costs might include the rent on their commercial location, any plumbing licenses or certification, bookkeeping staff, and business insurance. The third example is a cottage rental property. Revenue sources for a cottage rental include the fee you charge per night to the person who is going to stay at the cottage. The revenue may even include an extra fee you charge for your guests to have pets. Variable expenses for a cottage owner may include the complimentary shampoo, conditioner, soap, toilet paper, and other consumables a guest may use, such as complimentary coffee and tea. These variable items are going to change based on the number of nights that you have booked for a season and the consumption of each guest. Fixed expenses could include the repairs, maintenance, and insurance for the cottage. Whether there is no one renting the cottage or 100 people have rented the cottage, these expenses need to be paid. In reviewing all the examples of the business, the food truck, plumbing company, and cottage rental business, fixed costs are often common and consistent across all businesses. But the variable costs change depending on the type of business. Your goal as a business owner is to make a profit. To determine profit, you take all the revenue the business brings in from customers and reduce it by the cost of goods sold, which gives you the gross profit. Then you take off all the expenses to determine the business's income. The net income is the net profit your business earned after paying taxes. As a business owner, you need to use strategies to keep costs lower than your total revenue income. This is achieved by maximizing your sales, controlling costs, and managing expenses. Be diligent by comparing your gross profit margins and watching for fluctuating and rapidly increasing expenses that may impact and lower your anticipated profit. If you do not anticipate a profit, you must look for ways to increase your revenue and cut your costs. But when looking to reduce costs, there are several areas you should explore, such as looking for new suppliers, or have discussions with your suppliers about if they have any loyalty programs or discounts that can help you to reduce costs. Also, be sure to examine your budget sheet carefully to see where you may have over-anticipated sales and undervalued expenses. Take the time to double-check what the competition is charging, as you may be able to potentially increase the selling price of your product or service. If you realize you may not be able to obtain your anticipated profit, be sure to watch your accounts payable for any outstanding bills. The two areas you need to keep examining are the gross and net profit margins. They are two important financial metrics used to assess a company's profitability, but they measure different aspects of profit in relation to revenue. Where gross margin equals the revenue minus the cost of goods sold. The gross margin provides you with a measurement as to the percent of profit your company is making. A higher gross profit margin indicates that a company retains more money from sales after covering the cost of producing goods or services. This suggests better efficiency or pricing strategies. A low gross margin might indicate that a company has high production costs or ineffective pricing. The net profit margin is a financial ratio used to calculate the percentage of profit a company produces from its total revenue. Gross margin is not more important than the net profit margin, but they each provide you with valuable information to assess the performance of your business. In addition to financial ratios, a business owner needs to be able to calculate their break-even point, which is referred to as a break-even analysis. A break-even analysis helps you determine how many items you need to sell in order to determine at what point you will break even. A break-even analysis is a financial tool used to determine the point at which a business's revenues exactly cover its costs, meaning there's no profit, but also no loss. The key components of break-even analysis are the fixed costs, the costs that do not change with production levels. An example again is the rent, salaries, and insurance. The variable costs, which are the costs that change with the level of production. Again, an example are the raw materials and direct labor to produce the product. In order to determine a break-even point, you need to determine the total cost of your goods sold and the total sales you have made. The formula used to calculate the break-even point is you take the total of all your fixed costs and divide them by the total sales revenue minus the cost to make the product. A break-even analysis is important as it helps you set realistic sales targets. It assists you in pricing decisions. And it is very useful for financial planning, especially for a startup business, and it helps assess the risk level of a business. Being able to identify correctly the variable and fixed costs of a business are important not only to determine your company's break-even point, gross and net margin, but there are other profitability ratios such as return on investment margins that can inform a business owner as to how well they are doing managing their business. We at CBDC hope you will continue to learn more about how you can manage the financial activity of your business. Thank you for joining me to learn about planning and preparing a budget.